Let's talk to Matt Maley, Chief Market Strategist and Managing Director at Miller Tabak. Matt, welcome. Your reaction to what you're hearing coming out of Jackson Hole and Jerome Powell?
Yeah, it's just there's no question that it's kind of funny. It's almost exactly what we saw in December of last year, where the many members of the Federal Reserve came out and spoke hawkishly, in late November and through most of December. But markets didn't really necessarily believe it. Then finally, when Chairman Powell came out and confirmed it in mid to late December, finally the market started paying attention. That seems to be what's happened this time around as well. Remember, he was kind of dovish in July, but since then, everybody else has been very hawkish, and then he confirmed that today. Now the markets are paying attention to it. And the only thing I would add is that the bond market was already starting to pay attention to what the Fed, members of the Fed were saying. So now the stock market is playing catch up to that.
Jerome Powell warned to expect some pain. Translate for us from central banker speak. What does that mean? What does that look like?
Well, I mean, what he said, and it's something I've been saying for a long time, is that, we have this problem of inflation, and some people were saying, well, if the economy starts to get weaken, they'll change. It's like, well, they can't change unless inflation comes down, because if inflation stays high, as Chairman Powell said today, the recession will be even worse. So the pain is that, it's kind of what we saw the last time we had serious inflation in the late 1970s, is that we're going to have to, there'll be a weakening in the economy. I'm afraid there'll be a weakening in earnings. That'll cause the stock market to come down. But it is the right thing to do, because it will allow us to avoid a much worse recession. And, recessions and bear markets are normal. They're healthy. They're part of a capitalism. They're okay. And the thing is, we just got to work our way through it and have some money at the other end of the other side. And that's why I've been saying people should raise a little bit of cash, and have been saying that for a couple of weeks now.
The U.S. economy shrank less than previously estimated. Do you think that has perhaps eased the fears of a deep recession?
Yeah, I think so. And one of the things is a lot of people have been talking about a mild recession. I think we're going to probably have something more than a mild recession. I think that's what Chairman Powell was alluding to today when he was talking about using those pain words. But that doesn't mean it has to be a horrible recession. One of the things that has been scary is that the last two deep sell-offs in the stock market in 2000 and in 2008 were 50%. We don't necessarily have to have that. And people worried that, if it means recession, it means another great financial crisis. That's not what it means. But it does mean we'll have to see some more pain. I just don't think it'll be quite as bad as it was 12 years ago.
The U.S. economy is doing comparatively better than economies in Europe and in the U.K. Why is that?
Well, a lot of it has to do with the war in Ukraine, and it's just that situation has made inflation much worse there than it is here. I mean, both on food prices and on not just natural gas and oil prices, but food prices as well. And of course, this natural gas issue is so important to fertilizer, which is going to keep food prices elevated for a while. So they have a bigger inflation problem than the U.S., and that's why they're underperforming the U.S. right now.
Maley in the United States, thank you very much indeed for coming on the program and talking to us.
Thank you. Have a great weekend.